Welcome to This Explainer. Okay, so if you hear the phrase month-end close and immediately think of, tedious administrative chores, endless spreadsheets, and late nights fueled by cold coffee in the accounting department, well, I want you to completely rethink that right now. Today, we're going to look at the month-end close not as some chore, but as the critical hub and the absolute ultimate test of a company's operational health. It is literally the core of the business cycle.
To really grasp the high stakes involved here, consider this quote. If any upstream cycle has errors, the close process is where they surface. Think about it. Every single transaction, every sale, every paid invoice, every depreciated asset, it all flows right here. This means all those hidden errors, from missed accruals to bad cutoffs, will inevitably bubble up during this process. You simply can't hide operational flaws from a well-run close. It is the ultimate truth teller.
Okay, let's dive into this structured roadmap for mastering a flawless close. First, the hub of the business. Second, velocity and close types. Third, stage 1, the calendar. Fourth, stage 2, the cutoff. And finally, stage 3, upstream confirmation.
Part 1. The hub of the business. Converging all cycles into financial truth.
So, a world-class close actually operates on a 24-stage, 6-phase system, but we're going to hyper-focus on Phase A, which is close preparation and calendar management. And notice this engine block actually begins in the last 2 to 3 business days of the month, not after the month ends. You really have to think of Phase A as the physical foundation of your company. It has to be properly prepped and bolted down to receive outputs from all the other business cycles so it can successfully assemble accurate, reliable financial statements.
Moving to Part 2, velocity and close types, the need for speed. When we evaluate the health of this process, the ultimate metric is close velocity, which is simply the number of calendar days from period end to the final financials. But velocity isn't just about rushing, right? It's the primary measure of how efficiently your entire business operates. 3 to 5 days. 3 to 5 days represents a world-class close for management accounts. If your team is hitting this target, huge congratulations, because you are an accounting unicorn. It means your data is clean, your upstream cycles are humming perfectly, and management is getting the rapid insights they need to make real-time strategic decisions. Contrast that sharply with 15-plus days. If your close is consistently taking over 15 business days, I have to warn you, this is a severe operational red flag. It almost always means you've got upstream delays, people aren't doing their reconciliations during the period, or honestly, you're operating in total chaos without a formal calendar. Now, speed definitely depends on the kind of close you're running. A soft close, also called a flash close, happens around days 2 or 3. It gives management early, preliminary results, which is great for flash reports, even if it lacks some final accruals. On the flip side, a hard close, which hits around days 7 to 10, is the complete lockdown financial record, with all final entries and adjustments made. Let's get into the stages. Section 3, Stage 1, the calendar. The controller as air traffic control. Consider the anatomy of a proper close calendar. It is not just a simple to-do list. Every single task needs a clear description, a named individual owner, and I mean an actual person, not a whole department, a strict due date in business days, a list of predecessor tasks, and concrete proof of the deliverable. Without this formal structure of individual owners and strict dependencies, the whole process degrades into an unreliable ad hoc mess where things just slip through the cracks. And because those dependencies are so tight, you absolutely must have a strict escalation protocol. Step 1, identify any task at risk. Step 2, escalate it to the controller a full 24 hours before the due date. Step 3, take corrective action immediately. Why 24 hours? Well, because missed deadlines on the critical path don't just delay a single task, they delay the entire financial statement. Next up, Section 4, Stage 2, the cutoff. The golden rule of accounting. So the crucial point here is that this is arguably the most fundamental concept in the entire process. Cutoff is the golden rule that every single transaction must be recorded in the exact period it belongs to. Cutoff errors carry a massive risk because they completely distort reality. If you record revenue early or push expenses late, you are inflating or deflating current period results and doing it entirely at the expense of future periods. It just breaks the integrity of your financials. To prevent that disaster, you need specific rules across all transaction streams. For revenue, absolutely no recording until control has officially transferred. For expenses, everything incurred through the last day must be recorded.
whether you have the invoice in hand or not. For inventory, shipping and receiving must be meticulously reconciled. And for payroll, you must accrue through the final day of the month. Inconsistency here is literally the absolute easiest way to legally misstate your period end results.
Once that cutoff is applied, you have to build a physical barricade to protect the data. This is your subledger lockdown sequence, and it must happen in this exact order. First, accounts receivable is locked after the last billing run. Second, accounts payable gets locked after the last payment run. And finally, inventory is locked after cycle counts. This strict sequence prevents late postings that would otherwise force a disastrous, incredibly time-consuming rerun of the entire close. After those subledgers are locked down, you face the ultimate gate, ERP period control. The accounting period in your software system is only closed after all calendar tasks are complete and the controller explicitly signs off. Once this period closes, ordinary users are completely locked out. Nobody gets back in to make a backdated entry without an act of Congress or, explicit top-level authorization from the controller.
Which brings us to Section 5, Stage 3, Upstream Confirmation, the final gate. The key rule at this stage is incredibly firm. Upstream status confirmation must be documented, never assumed. You don't just take someone's word for it passing in the hallway. If even one single upstream cycle is incomplete or lacks a signature, it halts the entire close process dead in its tracks. And this brilliantly illustrates exactly what we mean. The controller is looking for a dense, highly structured checklist for the 6 upstream cycles. Revenue needs deferred schedules updated. Procure to pay needs the GR&I list, that's goods received not invoiced, prepared and ready. Payroll needs liabilities current. Inventory needs its valuation. Fixed assets needs the depreciation run. And finally, Treasury requires all bank reconciliations to be 100% complete.
So what's the actual trigger to finally proceed? The controller must physically or digitally collect all of these vital documents: the signed status confirmations, the GNRI list, the payroll schedule, inventory valuation, the amortization run, and those completed bank recs. Only when this entire arsenal of documentation is gathered can the controller safely flip the switch and transition the team into the heavy lifting of Phase B accruals. As we wrap up this explainer, I want to leave you with a rather provocative question to ask yourself and your team. Is your month-end close a strategic hub providing rapid, trustworthy insights, or is it an operational red flag bogged down by 15-day delays and assumed confirmations? Take a really hard look at your velocity, your calendar dependencies, and your cutoff discipline. Master Phase A, and you master the financial truth of your business. Thanks so much for joining me on this explainer, and hey, I highly encourage you to go review your close calendar today.